I started with nothing. Granted, I was blessed to have an incredibly supportive family, but with regards to wealth creation, I didn't have much to lean on. While most of my buddies were out chasing girls or watching football games and drinking beer in university and in our early 20s, I spent almost all my spare time searching for more. I didn't know exactly what that more was, but I stumbled along for many years in the early 2000s searching for it. I devoured any and every book on investing and wealth creation, from stocks to real estate to even medical instruments. Once I came across it, I knew it was the start of the most exciting journey of my career. My mindset completely changed. And here's the thing, so can yours. You see, by 2005, I had already established myself in the resource sector, working with some very well known names. Learning the craft was a steep learning curve. But what I will share today definitely brought the most important dimension to my investment framework. I first read it in 2005. This book really helped me understand the thought process of Charlie Munger. It's called Poor Charlie's Almanac: The Wit and Wisdom of Charles T. Munger. It's over 400 pages of brilliance in a fun and easy format. I've read this book more than any other book, including my New York Times bestseller, The Colder War, which I had to reread countless times as I wrote it and then during the editing process. Writing a book is not fun, trust me. At the end of the book, Charlie Munger provides a list of his favorite books. His kids think he's a book with a couple of legs sticking out, so you know that books he recommends will be good. Once I got to the list, I jumped on Amazon right away and ordered every book. Not one of them disappointed. Charlie Munger is an amazing mind. When he says you should ignore mediocre opportunities, waiting for great ones instead, you should listen to him. In a recent interview, Charlie Munger was asked, "Do you expect the next 10 years to have lower returns than in the last 10 years?" In one word, he answered point blank, yes. And he went on to say, "The frenzy is so great, and the systems of management, the reward systems are so foolish that, I think in real terms, the returns will be lower." This is one of the best investors in history ever. He's navigated through many bull, bear, and echo markets and became a billionaire. He is Warren Buffett's guru. Now, is he just an old and out of touch grandpa? No way. Back in February 2020, he warned of wretched excess, and his warnings were blistering. Now, even though I'm very bullish on resources and commodities, with gold and our gold stocks in particular, I am stressing everyone to be patient and not chase any stocks. Right now, stocks in the S&P 500 are the most expensive they've been in 25 years, except during the 1999 to 2000 tech bubble. That's the chart you're looking at right now. The tech world has gone parabolic over the last year as the fear of missing out, FOMO, has taken hold. SPACs, IPOs, and deal flow bonanza. The enormous amount of capital flooding into SPACs and IPOs is unparalleled. To show this IPO mania, we can use the Renaissance IPO ETF as a proxy. You'll see it has skyrocketed over the last 12 months, soaring to new highs. That's the chart you're looking at right now. Just in the last 12 months, it's up over 225%. I find it ironic that the companies going public in 2020, post-pandemic, would demonstrate more robust revenues and cash flows than any time during the past 6 years. After all, that should be why the IPO ETF is at record highs. Clearly, that's not the case. The world economy shuts down, yet IPOs trade at record valuations. Call me old school or old fashioned, but that seems like a stretch to me. Let's not forget about the FANGs index, which is composed of the largest technology companies. It has soared 150% over the last 12 months. That's the chart you're looking at right now. However, as the saying goes, the market can stay irrational longer than you can stay solvent. So I'm not shorting the market. That's not my area of expertise. I stick to what I know and have the top performing track record in my sector by sticking to my framework. The disconnect between the real economy and the stock market has led to many subscribers and readers wanting additional portfolio protection. I still believe there is considerable uncertainty in the world, and the valuation of the global equity markets is vastly different than what the current economic situation suggests. While most equity indices are at or near record highs, euphoria continues to soar. It's not just the retail crowd, it's also the institutional crowd. We can measure this in different ways. One way to look at the chart and see share prices at record highs. That's obvious. We can also measure it using various indicators that measure the number of advancing stocks minus number of declining stocks. A third way, which is more forward-looking and can really show the true euphoria or FOMO factor, is through a ratio called the put to call ratio. We call this the FOMO indicator. The put to call ratio measures the number of put options purchased relative to call options purchased. Investors who are optimistic will buy a call option, which gives them the right to purchase a stock at a specific price at a specified time. A put option works the opposite way. Investors who are negative will buy a put option. A put option gives the owner the right to sell at a stock at a specified price by a specific date. If we use this approach for every stock in the New York Stock Exchange, it provides a good indication of which way money is leaning. When call buying exceeds put buying, the ratio is below 1. When put buying exceeds call buying, the ratio is above 1. So the put-call ratio equals total put option volume divided by total call option volume. This ratio can be calculated every day, week, month, etc. The chart you're seeing right now is the daily put-call ratio we put together from 1998 to today. But we smoothed it out using a moving average to remove outliers and help show a clear picture with a more general trend. This is the put-to-call ratio. Recall from above, the lower the ratio, the more call option buying exceeds put option buying. This means investors are very bullish. If you look at the dashed bottom red line, you see that investors are at the most bullish point since the tech bubble. For the math fans, if you look closer at the chart, you'll see I've calculated the mean, which is 0.62. But I've also calculated 1 and 2 standard deviations away from the mean. That's why you see these different lines. You will see that we are more than 2 standard deviations away from the mean. We've only been this far away once before in the 20 plus years of this data set. With such overwhelmingly positivity and confidence in the market going higher, my alligator senses really start to tingle. This leads us to the obvious, logical thought of risk mitigation and portfolio protection. I'm not saying a sell-off is going to happen tomorrow or next week. It may not even happen in 2021, but it's our duty to be prepared for one. If there is a panic sell-off, we need to be protected. What goes up must consolidate to go higher at a minimum. Don't get fooled by all the gold bug media. Gold stocks are just like any other asset class in a panic and will sell off. In fact, they could sell off harder than regular blue chips. The reason is investors rush to sell winners to pay off losers or margin calls. So we could actually see the precious metal stocks sell off harder on a relative basis than the generalist S&P 500. We saw this phenomenon in both of the recent market sell-offs in 2008 and the most recent one in 2020. In 2008, gold stocks bottomed out 62% down. The equity markets bottomed several months later, down roughly 50%. That's the chart you're looking at right now. It was the same situation during the March correction in 2020, where gold stocks outpaced tech and the S&P 500 in losses. Gold stocks were down 46% and bottomed several weeks earlier than the general market indices. The chart you're looking at right now is the 2020 coronavirus meltdown. The red line was the gold miners GDXJ. You can see that it had the biggest drop in the first week of March, and it fell down 46%. Whether Charlie Munger is right and the decade will be a loser in real terms is something that will take time to play out. Over the next 6 to 12 months, we should begin to see the impact of stimulus packages on inflation expectations, both domestically and abroad. I believe the Katusa Resource Opportunities portfolio has positioned itself incredibly well to take advantage of the markets over the next 12 to 36 months. Our growing watch list of companies will provide us with targets if there is a correction, while my specially designed insurance play could more than offset any market declines. We've already hit 2 of our watch list buy targets. The way of the alligator works. As always, I am on the hunt for new opportunities that I share with my subscribers, and I invest my own money in at the same terms and at the same time. And we have some very, very exciting prospects in the pipeline. There's one company that's at top of my radar right now, and I'm weeks in or even days away from sending an alert to my subscribers. It's a brand new company that I'll be putting a significant amount of money into and making it a stable in my precious metals portfolio. Chances are you've never heard of it, and you won't until it's too late. The last time I alerted readers to an opportunity that was imminent like this, I had to close down subscriptions to the Katusa resource opportunities. As my subscribers know very well, to get in the deal, you have to be in the room and ready to act. If you are looking to give yourself an edge in the resource sector, my premier research service might be for you. Now look, our channel has grown tremendously in the past year, and we'd like to thank our viewers on YouTube by announcing the Katusa Fellowship, where I'll be giving away 2 annual subscriptions valued at $3,500 per year of my premium research to our YouTube audience. All you have to do is click on the link in the description below to register for the Katusa Fellowship. Stay safe.